Morning, Market Chameleons and Dmitry Pargamonic. How you doing this morning, D?
Good morning, Will. How are you?
Great. Let's jump right over to the disclaimer. Get that out of the way.
So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not giving you advice or telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's a disclaimer.
Excellent. What are you seeing in the pre-market this morning? Anything?
Yeah, let's take a look. I think what we'll do is something similar to yesterday. We'll quickly scan the pre-markets, see what's moving. I'm going to take one stock and just kind of go through like a fundamental analysis in it, and then an option strategy trade idea with it. So, we'll do something similar to what we did with Target, Procter & Gamble, and Verizon. So this is the pre-market report. We got the most active stocks trading in the pre-market, biggest percentage gainers, biggest percentage decliners. I'm going to take a look at what's going on in the higher market cap stocks. So I'm going to use this filter here, market cap 20 billion or higher. So we got 5 on the percentage gainers list, 80 on the percentage decliners list. From that perspective, looks like a weaker opening, weakness at the opening or bearish bias. When I scanned through this, one that popped out at me today was Nike and KE. And I think that, they are down. There's some news there, something related to, some conflicts in China. But it also popped in a bearish opportunity yesterday. So, just because those two kind of popped out at me, I think I'll just look at Nike today. We'll look at that bearish option strategy opportunity and take a look at it like from a fundamental point of view. Let me just go to the unfiltered report before we do that. So here's 46 on the unfiltered report made the percentage gainers list, 333 on the percentage decliners list. So, besides the higher market cap stocks, just looks like the market on a broad-based looks weaker at the opening. To save time, I'm just going to kind of jump ahead unless somebody has questions on any of these pre-market movers. Will?
All right, they're a little behind us. Looks like nothing on the pre-market right now.
Okay, and if you do, I'll jump back to it if you have a question pop
All right,
in.
great.
I'm going to go here to the home page, and on the home page we have these tabs here, which are trade ideas, options trade ideas. We have stocks that are most active. 2 different bullish tabs here. One is based on seasonality. The other one is based on a technical. Then we have a bearish opportunities tab that's also based on technicals. So what it does looks at stocks that are in a technical downtrend or bearish crossover, and then there are also options lining up that present a bearish play with a theoretical edge. So on this bearish opportunities tab, I'm just going to kind of scan down here, and I see Nike on here. So these stocks right now here, Apple, Baba, TSM, Netflix, right now, they're in a technical bearish either crossover or downtrend. So got, Apple right now on a bearish crossover. Alibaba has been in a bearish crossover for a while now. TSM made a bearish crossover, Netflix, and Nike. So over here, it's in a bearish crossover. It did find then it scans for different option combinations from our screeners, and it's using our preset filters. You can go to the screeners and use your own filters. This is using our preset filters, and it found the following strategy. It's looking at the March 26th, so these are options that are expiring tomorrow, it's looking at a bear call spread. So buying the 140 call in March 26 expiration, selling the 135 call March 26 expiration tomorrow is a credit of 75 cents. We think theoretically it's worth 67 cents. That's a 2% theoretical edge, and a historical probability of success, 73%. So when you're selling, right here, you're selling a call spread, so you're receiving a credit, right? You're selling one strike and buying a strike above that, so you're receiving a credit, and you want to sell it above a theoretical edge. This theoretical edge is based on, if we took Nike and we looked at its historical stock behavior, and we lined up the same types of circumstances with same days to expiration, same distance of strikes away from the spot price, adjusted it for if there are earnings or no earnings, adjusted it for the implied volatility. We took those historical outcomes. What this is saying is, if you did that spread over and over and over in the last, I believe this is 6 years of data, on average, then value was 67 cents at expiration. Right now, it's 75 cents. That's where the theoretical edge is coming from. Historically, this is scanned it and said, well, what if you sold this spread historically at these levels? How frequently would have it resulted in a profit at expiration? In other words, you were able to buy back for less than you sold it for. That was 73%. Okay, so this is looking at historical stock behavior, adjusting for similar circumstances. So we're going to take a look at this bear call spread closer, but before we do that, let's just take a look at the fundamentals in Nike. And keep in mind, this is yesterday's closing prices. Market's not open yet, so we don't know where the options will be at the open. I'm just using this as just an example. So Nike, let's take a look at it. And I'm just going to take a look at it from a fundamental analysis first and an evaluation. I'm not saying anything bad about Nike itself. I think it's a good company. I think Steve Jobs said that Nike is probably the best marketing company out there, because they took a sneaker, which is a commodity, made it into like this premium product.
Yeah, supposedly they're going to get into the NXT business or NFT business, excuse me.
So we'll take a look at that and see if what you think, if the valuation is justified. But the NFT is what they'll digitize.
Yeah, well, they sell premium one-off sneakers, and there are rumors about this. I'm not saying they're going to do it, and I don't even know if it adds extra level of value. But the NFT space is so hot right now. I sent you a text this morning. A writer for the New York Times wrote a piece about listing an NFT and then sold at the same time.
Sold what?
He sold his article. It was published in today's New York Times business section.
Right.
And he also sold it as an NFT. Right now on the exchange, its bid is like $35,000 to buy the NFT of his article.
Okay. That's incredible. So
yeah, no, it's crazy.
Well, so we'll see. And I know that Nike is like kind of in that, also doing like limited edition sneakers, which take even, people are even buying them and flipping those sneakers, because with the limited edition, I think that there's like a secondary market in these sneakers. But let's still take a look at it from a fundamental perspective really quickly, so then we could jump into the options space.
Great. Before you get started, C. Robert Black from Chicago is asking, how often during the day do these trade cards update?
So the trade cards, so keep in mind the market data itself is on a 15-minute delay. So that's always at least a 15-minute delay. And then those trade cards will update on a timer based on the stock itself. So like a busier stock that trades more often and gets searched more often, something maybe like SPY, probably Nike, based on like, average option volume today. That will get updated more frequently. I think it's on a 5-minute timer. Something that's has zero volume, no trades, very wide markets. Those will update on maybe a 15-minute timer. So it just depends on the stock, but that's how 15-minute market data delay, and then they're updating on a timer because you need to accumulate the data, run the analytics. So that's how it works. Hopefully that's helpful.
Yeah, that is.
So let's take a look at, from a fundamental perspective, we're going to take a look at the profit margins, growth rates, valuation multiples, yields. Then we're going to take a look at where we think Nike's fair value or implied value should be around. We're going to estimate it, and then we'll see how far away it is from that estimate, how reasonable is our estimate, and how we could line up an option strategy to be aligned with that outlook. Okay, so let's take a look at, we're going to look at 4 different profit ratios for Nike. So gross margins in Nike, and these are, the gross margins are just whatever they sell their product for. It's subtracting the cost to make that product. So what's left over? Gross margins in Nike, 43%. In other words, they sell it. If they sell the product, they have 43 cents left over as profit after they deduct what it cost them to make that product. Okay, 43% gross margins, 32% in the S&P 500. So from that perspective, gross margins look pretty good compared to the rest of the market, and their gross margins looks pretty consistent over time. So they don't jump around. They're about mid 40s over time. Net margins, this is how much they have left over that is available to shareholders after they deduct cost of the goods sold, all their other operating expenses and other expenses, and any kind of other profits and losses they're generating from the business. So that's 7%. That's what's left over. Net margins, in other words, every dollar they sell, 7 cents is left over available to shareholders. That compares to S&P 500, 9%. So on that front, they're 2 clicks lower, and we could see here, it's been higher for sure in the past, and it dropped, came back up, dropped. So it's not as steady, kind of dropping around between, around 10, below 10, above 10. That's where it's looking at. Operating margin. So this is profits from its core business. So this will take out any type of other profits that they make from different types of investments. Either they bought bonds or stock or whatever they did. This is only looking at their core business, which is probably just selling sneakers. I don't know what other core business they have, but any core business that they're concentrating on, it's isolating that and saying from there, it's 8% operating margins compared to S&P 500, 13%. So from there, that's lower, than there's like 5 clicks difference there. And that to me just looks like it's been dropping, which doesn't seem good, right? From 14% to 12% to 8%. Maybe the coronavirus dragged it down a little bit. EBITDA, this is earnings before interest, taxes, depreciation, amortization. Nike 11%, S&P 500 8%, 7% spread there. Again, on that front, so gross margins look good. The other operating profits, those look like they're below the S&P 500, right? So then you have to make a decision. Well, where is it valued if my profit margins are lower than S&P 500? That's what we're going to take a look at. And you can see here, those have been also kind of dropping EBITDA. Growth rates. Well, how fast are they growing compared to the S&P 500? Maybe they're If they're growing very quickly, much faster than the rest of the market, maybe they still deserve a higher multiple. So let's compare that. If we take a look at their total sales, so those are total revenue, we see on 5-year average, 4% growth, 3-year average, 3% growth. Last year dropped 6% in revenue, probably coronavirus. But if we compare that to our benchmark S&P 500, it's either in line or growing at a lower pace. So, that's nothing there to write home about, right? They're not growing their revenues any faster than the rest of the market. Net income, they were able in the last 3 years to grow their net income 24%, but in this 1 year period, really they just matched the S&P 500. Again, that net income, you'd have to take a look at where that income grew from, because if it was like a one-time sale of something, a division or whatever, you'd have to kind of take that into consideration, because it's not something they could do over and over again. Operating income, as you can see here, no growth in 5 years, and probably last year dragged that down. But if we compare it to the S&P 500, nothing to write home about. Valuation multiples. So how are they valued versus the rest of the market? PE ratio, if we take their market cap, right? If we bought all the stock in Nike and divided by the trailing 12 months earnings, how much above are we paying? So here, currently 62.8, 3-year average 53.4, 5-year average 42.1. So that multiple has been expanding, right? It's been going up and up and up. And if we compare it historically to the S&P 500, historically traded at 62% premium, 3 years, average 93% premium. Right now, we're kind of in line with that 5-year average, 63% premium to the S&P 500. In the PE ratio, price to sales, that's just market cap divided by revenue. Also, it's been expanding. 3-year average 3.6. 5-year average 3.6. 3-year average 4. Currently 5.5. In other words, the market cap has been growing faster than its revenue, right? The market cap price of the stock keeps increasing at a faster rate than its revenues are increasing. And if we compare that to the S&P 500, it's at an 88% premium to the S&P 500, 2.9. Historically, it's 52%, 59%. So those are valuation multiples really quickly. So we see revenue, not so far, there's nothing that exciting about it, their revenue growth. We'd have to take a look at maybe something's on the horizon, maybe something's on the pipeline that's making people excited. I don't know if they're like entering a new market in China or something that could make a difference. But we saw today it was down on news related to China. So growth, nothing crazy. Profit margins, nothing that we see so far from our data to justify a very high multiple relative to the market. Yields, let's just take a look at the yields compared to our benchmark. So if we bought all the stock and kept the earnings, right? If we bought the stocks, kept all the earnings, it's ours now, right? If we bought the entire company, what is our return? So using trailing 12 months, your return is 1.6%. That compares to S&P 500, 2.6%. So you got to then make a justification. Well, that has to get better in the future. Otherwise, if that persists, this persists, you're better off in here, right? Hanging out in the benchmark than moving here. And that's kind of been, we see the 3-year average, 5-year average, that earnings yield was better in the S&P 500. Operating yield, those are just earnings from its core business, 1.8% return on invested capital, SPY 3.7. So keep in mind, this is based on not their equity, but actually the market cap. We're looking at the market cap. If you bought all the stock, what would have been what theoretically is your return. 1.8% S&P 500, 3.7% EBITDAT, 2% return versus S&P 500, 5.5%. So you just got to kind of wonder, it's nothing to say bad about Nike or their product or even their, management. That's not, here we're just looking at purely valuation. Has the valuation got it potentially ahead of itself, unless we could find a reasoning that the valuation is higher because something that we're expecting to happen in the future. Okay, let me know if you have any questions while I'm doing this. So having said all this, where do we think like Nike potentially, could be valued at? Let's go to the fundamentals here, look at fair value. We're going to look at it from two perspectives. One, using historical benchmark. One, we're going to use projected or estimated growth rates, okay, going into the future. So let's take a look at historical multiples. Here we see, so far, based on these historical multiples, this is what we see, that the implied value is $90.96. We're priced at 133, and that's 46.4% premium. So let's take a look what that means. If we use so right now the P ratio has been jumping around, so it skipped it here. So if we use the price to sales ratio, and we said on the 3-year average price to sales ratio is 3.9. If we use that as our benchmark, that implies a value of $94.23. Price to operating income, the 3-year average 28.8. If we use that as our benchmark, the implied value is 67.46. If we took these and we also said, well, how is that relative to the rest of the market? Right now, the price to sales ratio, Nike 5.7, S&P 500 2.9. That's a 97% premium to the rest of the market. Historically, traded at a 59% premium. If we use that as our historical benchmark, that's the implied value. So if we took the average of all these, right, we get 90.96. So that's the implied value using our historical benchmarks. And, we could change that going back to 5 years if you use the median, 5-year average, 5-year median. Let's keep it at the 3-year average. So let's now look at, okay, what about going forward? How does that compare going forward? And we'll use the rest of the market as our benchmark. So comparative model. In this model, what we're going to do is say, what if we used, I'm going to use 3 inputs right now. I'm going to use their operating margins. What do we think their profit margins are going to be? So this is an estimate. What do we think their revenue is going to grow at? Again, all these are estimates, and we're going to use the volatility as our metric for risk. Okay, so what we want to do is compare the operating margins of Nike to our benchmark, which we're going to use S&P 500. You could change it here. We're going to look at the revenue growth of what we think Nike will grow at versus the S&P 500, and the volatility compared Nike to S&P 500. Now, you could go in there, and open up their last earnings statement and see if they're giving you guidance on how much they're going to grow, what their operating profits are. I'm just going to reference the historical data and use that and assume, well, if that persists, where should it be valued? Now you could change any of these inputs. Again, I'm not giving you guys advice. I'm just sharing ideas. These are all estimates, and it doesn't have to persist. We don't know what's going to happen tomorrow, next year, or 5 years from now until it actually happens. We're just using our data and estimates. So operating margins. Currently, the operating margins, as we saw, 8% versus S&P 500, 11.5%. So let's give it a better scenario, because, we see here the implied value is $48. The market's awarding it 133 value. So maybe, let's say they return to their operating margins 5-year average, 12%. So I'm going to change this to 12%. In the last 3 years, revenue grew at 3%, 5-year average 4.2 last year. Let's give it a 4.2. So I'm going to give it a better scenario than the 3-year average. I'm going to say reverts back to growing its revenue at 4.2% year over year. I'm going to keep S&P 500 at 11.5% operating margins, and S&P 500 for the same period, it's going to grow at 4.3%. Let's just keep the volatility out of this for a moment, and I'm going to recalculate these. Okay, recalculate. Based on that, implied value 74.85. So to get it closer to this, obviously the market's either rewarding it better operating margins, better revenue growth, or both. But let's see how this looks like. So here I'm comparing benchmark versus stock. Benchmark market cap, if we bought all the stock in S&P 500, cost us 35.9 trillion. Based on trailing 12-month revenue, there's $12.2 trillion in sales. Nike, we bought all the stock, 209, almost 210 billion. The trailing 12 months revenue, 38.5 billion. So let's look at going out 5 years. SPY, if revenue grows 4.3% year over year, like we had in our calculator, this is how each year the revenue will grow to this amount. If we assume that 11.5% of that revenue we keep as operating profits, so these are our profits for each year, cumulative profits, $8 trillion in SPY in the next 5 years. Remember, these are estimates. If we bought all the stock today, 35.9 trillion, in 5 years we make 8 trillion. That's a 22.2% return on that invested capital. Nike, what if we assume 4.2% year over year growth in revenue? So this is what it would grow to each year. If we assume 12% of that we keep as profit, so each year that would be our profit. Cumulative profits 26.2 billion. However, the market cap of Nike is 209 billion. So if we bought all the stock, 209 billion, and that was our profit, that's a 12.5% return. So you could see here, based on those estimates, Nike would return less basically than S&P 500, right? So what would Nike have to be priced at is the question to equal this, right? Just to equal that benchmark, what would Nike be priced at? And that's 74.85. Let me know if you have any questions. And if I risk adjusted, that'll be even lower. Okay.
We see Robert Black again from Chicago is asking, does the trade card info use the calculator info that you're using right now?
No, the trade card doesn't use that. So it doesn't have a fundamental analysis. What the trade card does is just say, well, there's a technical downtrend. So let's see where, if the stock is now starting to reprice, maybe closer to a fair value, where's fair value? So then you'd have to come here and look at it. And this is a relatively new feature that came out much later than the trade cards. So you would have to come here to start referencing this. But the trade card does not take this into account right now. All right. So let's just assume that it's in a downtrend. Maybe there's some negative news out there as well that people have been counting on. You'd have to go there and research it. So even if we use this 90.96, maybe we're wrong. Maybe it's 100 or 110. It's up to you kind of to, give weighting to those estimates, right? There's other information out there. You'd have to read it because I didn't go in there reading what the management's saying or, what the analysts are saying. I'm just using this data here. Having said that, let's come back to, you know what? We're at 9:30, so I didn't get to this trade card. I mean, I could go for a couple minutes more if people want me to.
Just jump onto it. People who have to go get in front of their terminals will start trading. So you can, okay. Why not finish it up?
So we're coming here back to Nike, bear call spread. We talked about that this call spread was filtered out because there was a theoretical edge with a historical probability of success, 73%. If you go to that options chain, it will populate the legs of that strategy for you. Okay, so buying the 140 call, March 26th, selling the 135 call, selling the 135 call. You load that strategy, and this is what it looks like, the payout diagram at expiration. So 47, let me just see here. So this was the 135 call spread 140. So this one did reprice after that. So this would be the credit. This is the midpoint of the spread. And look, I'm already at 930. So I wouldn't be able to go through every feature here, but this is where you would go here to look at the theoretical values, and we could change some of these assumptions. I think now that it's 930, it's starting to just put in, pick up the new IV ranks for the day.
All right. Well, great stuff, D. Thanks for taking us through that. The chameleons were very pumped about this information. Any parting words of wisdom for the chameleon community?
Yeah. Thanks for joining us. Stay safe out there, everyone. Have a good trading day. We hope to see you guys tomorrow. Thank you very much for all your support.
All right. Have a great trading day.